Welcome, everybody. Sorry for the delay. We're happy to have everyone on, even though I can't see everybody momentarily, but I'll adjust that moment in a minute. My name is Guy Tragrasso, President and CEO of the Bellingham Regional Chamber of Commerce, and you are at one of our sessions that we like to call On Topic. These are peer-to-peer learning opportunities with the chamber, and we provide these as kind of an educational tool to members and to the community. And it's not an annual example of an on topic, but we have had VSH a number of times over the years come in and explain new tax policies, new impacts that can shape how your business may need to run and understand the new rules. And so since we were a little bit delayed in getting it launched up, I'm going to kind of forego the reading of the bios and the fact that I'm not sure how to get that screen back. So I am going to pass the virtual mic to both Madison and Matt. Please do self-introductions as you see necessary. And again, welcome everybody. This Zoom is being recorded. And so, yeah, we'll get to the Q&A afterwards. So thanks, everybody. And I'm going to turn off my camera and mic for the moment. So
thank you, Guy. You want to move us to the next slide. We'll just do a quick introduction. I am Madison Price-Zender. I am a principal here at VSH. I work out of our Bellingham office, and with me is Matt Richesender. He's a partner out of our Skagit office. Matt and I both work primarily with local businesses in our communities here in a variety of industries: construction, real estate, agriculture, timber, trucking. Matt has experience on both tax, audit, and business valuations, and I lead our tax department. So you're going to hear from both of us today. We can move to the next slide to take a quick peek at an agenda. Oh, we might have skipped it, but that's fine too. There we go. So this is what we'll go over today at a high level. And I'll just start by saying that the One Big Beautiful Bill has largely been seen from a tax perspective as being really positive for the business community and for many individuals as well. And what this bill did was two things. One, it extended many provisions that were actually going to expire at the end of 2025. So we had really big tax reform in 2017, and many of those provisions were temporary. They were going to expire at the end of 2025 if there wasn't any action or a bill passed in Congress. So this bill extended much of that reform. And then the other thing it did is it created a handful of new provisions as well. So we'll go over both of those things today, and I'm going to kick us off with some business tax provisions. So if you'll move us to the next slide, and one more there, Guy. The first deduction that I'm going to talk about is the qualified business income deduction. And I chose to go over this one first in that this is what I find to be the most widely used. I mentioned that Matt and I work primarily with local businesses. Many of those local businesses pursue this deduction, and it yields a really great benefit for them. So this isn't a new deduction. It's one of those deductions I just described where if there wasn't any action from Congress by year end, this deduction was going to expire. So this bill made the deduction permanent, and I'm going to use the term permanent a couple times today. You're going to have to humor me because nothing is likely permanent in today's world, but what that really means is there's no more expiration. There's not a looming deadline. There would actually have to be another act of Congress to remove this deduction in the future. So this deduction came about in 2017 with tax reform. And in 2017, the C corporation tax rate went down substantially. And this deduction was created to keep pass-through entities, so those are your S corporations and your partnerships, at a competitive tax rate with the C corporation rate. So this is a deduction that's eligible for those pass-through entities, S corporations, partnerships. It's also available for sole proprietors as well. So again, we see this deduction used quite a bit in our local communities. How it works is if a pass-through entity, say an S corp, generated $100 of taxable income in the year, that income would typically flow through to its shareholders, and they'd be taxed on that $100 on their personal tax filing. This qualified business income deduction is up to a flat 20% deduction on that qualified income. So in business earns $100, it would produce a $20 deduction that flows through to the shareholders. And really, then the shareholders are only taxed on $80 of that business income. So you can see just how material of a deduction that is, and how big of a change that would have been if that deduction were to go away. That would have really increased the tax rate for a lot of business owners. So this deduction is now permanent, it's here to stay, and it's also been made a bit more favorable, more easily attainable within this act as well. So in the background, how you qualify for this deduction is the business has to do a couple things. It has to either have a certain amount of W-2 wages, so you have to have an employee base of a certain size, or you have to have a certain amount of depreciable assets within the US. If you don't have those things, then your deduction starts to phase out, and it begins to phase out when your income reaches a certain level. Previously, that level was about 100,000 for joint filers. That level's going up to 150 now under this bill. So we're going to see more businesses be eligible for that 20% than we saw previously. The bill also introduced a new minimum deduction, so a baseline $400 deduction for all pass-through owners. So that's going to help your smallest of business, and it also could help businesses in a loss position as well. So overall, this deduction's now here to stay and is more favorable than it was before. Had we seen this expire, we maybe would have seen a push for businesses to reorganize their entity structure. So possibly, I mentioned that C corporation tax rate is low. We could have seen a push for these entities to reorganize and become C corporations. Now that this is here for the long term, we're going to see S corporations and partnerships continue to be a competitive entity choice. That always depends on your specific circumstances and goals of the individual business, but it's going to be competitive to still be an S corporation or partnership in most cases. If you'll move me to the next slide, Guy, another provision that I'm really excited about is this act has restored the ability to expense research and development costs. So since 2022, we've been operating under what's actually thought to be a legislative error. Since 2022, there's been a requirement that research and development costs cannot be expensed in the current year. Instead, they had to be capitalized and amortized. This actually had bipartisan support to not make it into tax law, but somehow it was overlooked, and this has been the reality since 2022. So what that looks like in practice is, say, a business last year in 2024 spent $100,000 on research and development costs. They're out that cash, they incurred the costs. They do not get a $100,000 tax deduction in 2024. Instead, they actually only could write off about $10,000 in 2024, and the remaining $90,000 ended up capitalized, and then the taxpayer would amortize it over the next 5 years. We saw this as really burdensome to local business, especially small business, in that they were out the cash, they spent that money, the 100,000, and they're not getting an accompanying tax deduction. That can be really strenuous on cash flow. So we saw a lot of local business at least pause and rethink their research and development expenditures, knowing that this was the reality of how the cost was treated. So really excited to see that this is corrected in 2025. So in 2025, we can again expense these costs in the year that they're incurred. If there is a local business, any business that is subject to these R&D provisions and has these capitalized balances from prior years, the IRS has laid out a couple different options to make them whole. So if you go back to that example of the corporation who spent $100,000 in 2024, they only got to deduct 10,000. There's 90,000 kind of looming there that they were going to chip away at. The IRS is going to allow a few options on how to treat that 90. They can either expense the full 90,000 in 2025 when they file their 2025 return. They can spread it out over 2 years, so expense it pro rata over 2025 or 2026. Or if you're an eligible small business, which mostly means that you have gross receipts under 30 million, then a taxpayer can actually choose to go back and amend their prior year's tax filings, take that full deduction, and then seek a refund from the IRS, and the IRS would pay the funds back to the taxpayer. Before any of those businesses make a choice on how to move forward, I'd suggest weighing those options. Each business could see a better benefit from different things. One business might fare better if they expense the full amount in 2025, whereas another one may see a better result by going back and amending. One thing I'd be cautious of with the amendment route is we're not really certain at this time how quickly the IRS will process those amendments. We've seen some other tax programs lately, particularly the employee retention tax credit, where the IRS has just taken a really long time to process those returns and really delayed getting the cash back in the hands of the taxpayer. So I would certainly weigh that unknown when considering my options here. And next slide, Guy, another business provision is an increase to interest deductibility. So I mentioned that small business is under about 30 million of revenue. Large business is over that, over 30 million of top line revenue. This provision is affecting your large business. And currently, those large businesses can only deduct business interest up to a certain amount of their net income. Right now, that's calculated loosely on EBIT, so their income before interest and taxes. They can't exceed 30% of that with an interest deduction. They're changing this with this act, so instead of EBIT, we're going to be dealing with EBITDA, adding back depreciation and amortization as well. So what that's going to look like is the bottom line is larger. Your 30% deduction has the potential to be larger. Really, you're giving the ability for these big corporations to deduct, these big businesses to deduct more interest expense. So it'll be favorable for obviously your highly leveraged companies. Often it's capital intensive businesses or businesses that have high growth plans. And moving forward, next we're going to look at some labor and compliance updates. As I mentioned, Matt and I work mostly with local business, so I do have kind of an employer lens here, but I'll also speak to what it looks like from the employee side, as we have a mixed audience today, and I think that would be helpful. So the first one that I'll go over on the next slide here is the new overtime deduction for employees. So this has come with a lot of media attention. It's a new deduction, and it is that employees can potentially deduct up to $12,500 or $25,000 if you're married filing joint of overtime from income taxation. So how that's going to look, Congress has pretty strictly defined this and kind of waiting for the IRS to echo it, but Congress has laid out that only the overtime portion of pay is really eligible for this deduction. So if you have an employee that was earning $20 an hour and their overtime pay is $30 an hour, only the overtime piece of $10 an hour is eligible for this calculation. So for 2025, employers are going to continue to tax overtime as normal. They're taxing it, they're remitting the tax to the IRS. How this would look is if an employee ends up eligible for this deduction when they file their personal return in April on their 1040, they would actually see a refund of this tax that's already been paid. So there's no changes to withholding in 2025. It's going to act as a tax refund. What does change for the employer is the employer now needs to report overtime on the employee's W-2. So the IRS has gone ahead and released a draft W-2 for 2025. There's a new box and a new code where the employer would put that information. The IRS is giving a grace period. They're calling it a transition period. They haven't fully defined what that means, but really what they're saying is we implemented this mid-year and good data might not be available. So there's going to be some sort of safe harbor for doing your best to get that information on the employee's W-2. What could be limiting and what we're seeing is most payroll softwares now, when they report overtime, if you go back to my example, they're reporting overtime as a line item on the pay stub as that $30 an hour, and they're not differentiating between that overtime premium piece. So we expect that most payroll softwares will be able to implement this before year end and have that data ready for employers to release, but that's what's really driving this grace period there. And the next deduction I want to talk about is the tip deduction. And this operates quite similarly to the overtime in that employers are still taxing tips. That tax is still being remit to the IRS. And the deduction, again, at least for 2025, is going to be factored on the employee's 1040 on their personal return. So employees can deduct up to $25,000 of tip income from income taxation. This deduction is only available in certain occupations. So the overtime deduction, it's all occupations across the board. The tip deduction is for occupations that customarily earn tips. And the IRS has released, as of just a few days ago, a list of what those industries are. Shocking, but accountants did not make the list. Nobody's tipping their CPAs, but it is mostly what we would expect to see. It's your hospitality, your food and beverage, transportation. So I'm thinking your delivery drivers, your taxi drivers, and then wellness and beauty industry as well. The reason they're limiting this, I assume, to certain occupations is to prevent abuse of the provision. I've heard a lot of jokes about, oh, well, I'm just gonna convert my wages to tip income. Everyone pay me in tips. And this is one of the ways that they're tightening that potential abuse from occurring. The other way that they're doing that is they've gone ahead and said that the tips must be voluntary. So you can't say, oh, you know, this part of my service is a tip and this part is a base fee. It has to be voluntary. The customer has to be driving that. It'll be interesting to see how far they go with that comment. I used to wait tables before I practiced in accounting, and it was pretty normal to sometimes have imposed tips. So for example, if you were serving a large party of a group of 10 people, then you said, oh, you have to tip 18% for large parties. It'll be interesting to see how far the IRS reaches with that voluntary comment, and that could be a bit more administrative burden from the employer standpoint. But as of now, employer responsibilities really are largely unchanged with tips in that, yes, now tips have to be on the W-2, but they already were on the W-2. They were already reported in a separate way. So as long as payroll systems, point of sale systems are set up to track tips in a solid way, this should be pretty smooth sailing for the employer. And on the next slide, Guy, I'll just, so we're gonna see those new boxes on the W-2, and I'll just comment briefly on the employee perspective. So again, this overtime and tips is taxed, and the deductions on the employee's return. There are limitations for those employees on when they're eligible to take that deduction. If income rises to a certain level, they're going to see a phase out of this deduction. It's about 150,000 for married filing joint. So really it's targeting your low to mid wage earners. It's good if business owners can have an understanding of that concept and what it looks like on their employees' tax filings. Matt and I have certainly heard from some business owners that HR is getting questions from employees on what this looks like, and they have questions as their overtime and tips are still being taxed in 2025, and if they can expect that refund. So something to be aware of. And then two small administrative changes. One is related to the 1099 NEC. So that's your 1099 non-employee compensation. That's your rebranded 1099 miscellaneous. So it is for fees paid for services to an unincorporated entity or individual. Often we think of subcontractors. We have had to issue 1099s to those people if fees for services were over $600. We've been dealing with that $600 threshold for many, many years now. I'd say close to even a decade. It's been $600. That limit is increasing to $2,000 starting in 2026. And this bill is going to make it so that amount's indexed annually going forward. So we'll no longer see a stagnant value. It's going to increase each year. Another change is to the 1099K reporting threshold. This is something that's often misinterpreted in the media. So this is when you hear people say, oh, Venmo's going to 1099 you. Close, but not exactly. The 1099K is only going to be issued to business accounts, so not your individual Venmo account. It's your business Venmo, your business PayPal, your business Etsy. And then the threshold has now been increased. So they're only going to issue a 1099 reporting slip if that business has over $20,000 of gross payments and over 200 transactions on the platform. Then that's when you're going to see a 1099. So just a takeaway to make sure that all accounting and payroll systems are set up for success on these new changes. And I'm going to pass it over to Matt next to cover a few more provisions.
Great, thank you, Madison. First, I'm up on my list is talking about the solar and energy credits. Guy, if you could go to the next slide. The solar and energy credits are being phased out under the new bill. As you see here, there's various dates that each credit is being phased out, beginning with the end of the month through the middle of 2026. So if you're planning to make a solar or energy efficient property purchase, we recommend acting quickly. For one reason, the credit could be the end of the month, but also the fact that there could be a rush on these types of projects for people trying to get the credit before it is phased out. And then after June of 2026, there are no more federal incentives for solar and energy credits. With that being said, though, you should look at your state and municipalities because they often offer their own incentives, including the state of Washington. So check with your state and local government before you make your purchase, and you could still receive some of those credits at the state level. Guy, can you go to the next slide? The next topic is qualified production property. This is a new tax provision. It's intended at increasing manufacturing infrastructure in the US. The provision allows for an immediate deduction of the building or factory in the year that the building is placed into service. To qualify, the building must be a newly constructed or acquired building located in the United States. It must be used for manufacturing of tangible personal property, agricultural production, chemical production, or refining of qualified products. And examples of refining qualified products are refining crude oil into gas or converting wood pulp into paper. So it's a new deduction. The dates are here as when the construction must start and when the building must be finished by, so people have time. But as most people know, buildings don't just come up overnight, so it's important to plan ahead if you're going to pursue this tax provision. Guy, could you go to the next slide? So next, the bill extended qualified opportunity zones and it made it permanent. Qualified opportunity zones are in an economically distressed community or area where new investments may be eligible for preferred tax treatment. And to qualify for this preferred tax treatment and invest into an opportunity zone fund, first you must have a capital gain. Then you must invest your cash from that capital gain into the qualified opportunity zone fund within 6 months of the capital gain triggering event. Then the qualified opportunity zone fund must improve and invest in qualified opportunity zone property or business located in that zone. There are 3 tax benefits from opportunity zones. The first tax benefit is deferring tax on your capital gain for 5 years. The second tax benefit is a reduction in your capital gain if the qualified opportunity zone fund is held for 5 years of 10%, or if the qualified opportunity zone is located in a rural area, then it's a reduction in your capital gain of 30%. And the last tax benefit, which is probably the most significant for most people looking at this avenue, is that there is no tax on the sale of your QOF if the QOF is held for 10 years and sold before 30 years. If you hold your investment for over 30 years, at your 30-year mark, you actually get a stepped up in basis that eliminates the tax on the appreciation for that 30-year period. So it has really big impacts on people that have appreciating property businesses. It can be a great tax planning strategy. But there are some downsides of investing in opportunity zones, which include additional risk for investing in an economically distressed area, investment restrictions, additional administrative burden and cost of holding the QOF investment. For example, there's increased complexity of your tax reporting and tax penalties if the QOF rules are not followed. There's there's opportunity zones both in Whatcom and Skagit County. There's a link here, and I believe we'll send out these slides where you can look up where the opportunity zones are. If I remember correctly, it's South Bellingham, the Lummi area up in Whatcom County. Mount Vernon has some areas, Sejawole. So there are areas around here that are opportunity zones, and you can take advantage of this this extended provision. Guy, can you go to the next page? This is a very favorable tax provision that got extended and expanded for business owners that purchase a lot of equipment primarily, but other types of property. Bonus depreciation was restored back to 100%, and it was made permanent. As Madison's alluded to earlier, permanent is never permanent, but there's no expiration on this. So Congress would have to act and repeal this. Bonus depreciation applies to both new and used property. And the bill also expanded Section 179, and which also allows for an immediate deduction on qualifying property if bonus depreciation isn't suitable for the taxpayer. But the long and the short of it is you should be able to depreciate 100% of the equipment in the first year in most cases. So we recommend meeting with your tax advisor and discussing depreciation strategies for your particular situation, as there might be more tools in the toolbox for you to look at. The next, kind of switching to investing in ownership, is some of the other provisions that came through, was the bill extended the estate and gift tax exemptions. It preserved them at 15 million per person, or 30 million per married couple if you're in a community property state like Washington. It also preserved the annual gift tax exclusion of 19,000 per person. And also one thing that will impact most people in this room, since the majority of the audience is from Washington State, is there were significant changes and increases to the Washington estate tax that you should be aware of. The threshold's much lower at 3 million index for inflation per person. So it's important that will reach more Washingtonians. So I would definitely recommend a gifting strategy and consulting your tax advisor on that. It's still a great time to gift wealth, but careful planning should be considered before you make your gifts. One thing that is also still available is if you own a small business, you can do valuation discounting for family businesses, minority interests. So business valuations can be a really good tool for you to gift property out of your estate if you need to do that. The next slide. The last slide that I'm going to talk about is the qualified small business stock. The bill expanded the qualified small business stock gain exclusion. The QSBS gain exclusion, or some people refer to it as the 1202 gain exclusion, allows you to exclude a gain on the sale of qualified stock if certain conditions are met. The exclusion is only available for C corporation stock. The bill increased the amount of gain that can be excluded up to 15 million. The bill raised the asset limit from 50 million to 75 million. The stock does have to be held for 3 to 5 years. If you see the slide here, there's different holding periods of how much gain can be excluded depending on how long you've held the stock. And then also the new rules only apply to stock issued after July 5th, 2025. This is a great strategy for certain businesses and industries. However, I would just say when planning for a QSBS, it is very important to plan ahead to make sure that you're going to eventually qualify upon the exit. We recommend having a solid transition plan in place from inception, and the tax planning throughout the time of the investment is critical to understanding whether this is the right avenue for you. So I would just caution people on that, but consult your advisor because it's a great tool, and the rules have expanded pretty significantly where more people qualify or more businesses qualify, and it has a greater benefit. I'm going to pass it back to Madison, as that's all I had.
Thanks, Matt. I want to go over some changes at the individual tax level. There are a lot of them in this bill, and I've highlighted on the next slide just a few of the largest changes. And one of those is the tax rate itself. So we've been dealing with a maximum tax rate for individuals of 37% since 2017. That rate was actually one of those expiring provisions. So had nothing been passed in 2025, the rate was going to jump back up to 39.6%. That low tax rate of 37 has been made permanent. So we are locked in now with the tax rates that we've been used to since 2017. Same with the standard deduction. So in 2017, the standard deduction went up quite a bit. Right now, it's about $15,000 for an individual and $30,000 if you're married filing jointly. Had we not seen an extension of that, it would have really been cut in half and gone back to the levels that were consistent with pre-2017 tax law. So those higher standard deductions are here to stay. Those deductions, just a reminder, are when you itemize, it's the sum largely of your mortgage interest, your state and local taxes, and your charitable contributions. So the sum of those things has to be over 15,000 or 30,000 if married to itemize. Otherwise, you're taking the standard deduction, it yields a better tax benefit. So the reality is a lot of taxpayers no longer itemize. There's several taxpayers that they are just going to take the standard deduction. So that would have been a big change to cut those deductions in half. Building on that, there has been a change for those who do itemize. So I mentioned that your state and local taxes are included in your itemized deductions. The state and local taxes include property taxes, sales taxes, and state income taxes. Washington doesn't have a state income tax, but if you have income that's generated from a state that does, then you may pay state income taxes as well. So those three taxes collectively, taxpayers have only been able to include $10,000 of state and local tax when they itemize. In Washington state, property values are going up considerably. To reach a $10,000 state and local tax deduction, I think I asked AI, we'll see if it's true. You're roughly at about 1.3 million in property value to generate that type of tax bill. So between high property values and then our high sales tax, we do see a lot of taxpayers who exceed that $10,000 level of what they're paying in state and local taxes. So that cap is temporarily, this is not a permanent item, temporarily increased to $40,000. So for those who itemize, that's gonna be a big change for them. The $40,000 does phase out when income is over a certain level. So for higher earners over 500,000, they are going to start to lose that $40,000 deduction. So something to be aware of for those high wage earners. Another change with deductions is there's a new charitable contribution deduction. So I mentioned that a lot of taxpayers no longer itemize because the standard deduction's so high. There is a new charitable deduction for those who are not itemizing. They can still take advantage of a charitable contribution deduction. So if they donate $1,000 if single, $2,000 if married filing joint, they can still see a tax benefit of that deduction. Previously, if you weren't itemizing and you're contributing to a charitable organization, you're really not getting any tax benefit. So we actually saw this in one of the COVID relief bills back in 2020. It was there for a temporary amount of time. So happy to welcome it back. I hope it has a positive impact on some of our local nonprofits or our local charitable organizations. And then another new item related to charitable deductions is there is a new floor for those who are itemizing. In order to include your donations in your itemized deductions, the donations have to be over 0.5% of your adjusted gross income. So that is new. We're used to a ceiling on those deductions. You can't gift away all of your income, but the floor aspect is new. There's also a new enhanced senior deduction. So there was a lot of talk while this bill was moving through Congress of no tax on Social Security, and that did not make its way into this bill, but perhaps in lieu of that is this new senior deduction. It is $6,000 for taxpayer and spouse, so each can have $6,000 deduction if you're over the age of 65. There are income phase out limitations. It's around 75 if single and 150 if married filing joint, where that deduction starts to go away. Another new deduction is that taxpayers can write off up to $10,000 of passenger vehicle loan interest. There's some rules here. The vehicle has to be purchased in 2025 or in the future, and the assembly of that vehicle has to be within the US. There's also some requirements about the weight of the vehicle, so it does have to be a passenger vehicle, and there's income limits as well. So taxpayers have to be below 150 if married filing joint to be eligible for this deduction. And moving to the next slide, just want to go over a little bit of strategy before we close today. So next slide, Guy. We gave you a lot of information. What does it mean? What are you going to do and take away from this? We know that at least through 2028, we're going to have low tax rates and high deductions. So this is a good tax climate to recognize income. We could see strategies like Roth conversions, or we could see a delay of deferral strategies. We talked about all these changes to depreciation and to interest deductibility. We could see businesses really reconsider their decisions to buy versus finance equipment or acquisitions. Matt mentioned we have high estate and gifting thresholds, so we're likely to see accelerated gifting strategy over the next few years. And then just a caution to be really nimble with your tax plan. Things change so quickly these days, And this was a really big tax bill, but there is a little bit of tax that could move forward in some bills even before 2028. So just continue to monitor and be ready to pivot your strategy. And I have one more slide of action items. So for those businesses who do have research and development, be sure you're capturing that catch-up deduction. All employers, make sure you're ready for these new compliance changes. Employees, make sure you're ready for taking these deductions on your personal returns. It's the last call for any of those energy incentives. Businesses taking the qualified business income or depreciation deductions. Just make sure you're best positioned and strategic in what's best for the business. Be really aware of all the implementation dates that we talked about today. It is not all the same. Some were retroactive, some dates start in 2025, some are 2026. So pay close attention to your planning. And then just a great time to meet with your CPA or your tax advisor to go over planning before year end. This is what we love to do, is to take away action items from this bill and help it become strategy for local business. I do have one slide next, Guy. You know, we scratched the surface today on this tax provision, but one area we didn't go over is cross-border and international taxation. There was a lot of changes to international taxation within this bill. So if you're a business doing business cross-border, there is a webinar that VSH is hosting this week that'll get into some of that detail. And before we open we have a few minutes for Q&A, we have another slide next with, if anyone's interested in signing up for our newsletter. Congress just passed this big bill, and then the reality is it takes the IRS quite a bit of time to catch up. So in the months following a bill, there's often a lot of press releases, updates from the IRS, and we'll keep you up to date as things evolve. So I don't know if we saw much Q&A come through. If anyone wants to type in any questions. Oh, here we go. Is the 1099 miscellaneous rent interest also increasing to 2,000? Yes, that's my understanding. And the charitable contribution doesn't kick in till 2026, I believe. And then a question on the floor of donations from Rochelle. Yes, the floor for donations is for those who itemize. Their charitable donations have to exceed 0.5% of their adjusted gross income to even get in the door and be included in your itemized deductions. So you kind of have to jump through that hurdle to even see a benefit from your donations. We've got more questions coming in. When does the senior deduction go into effect? I believe that one is 2026. It might be 2025. Matt's gonna fact check me. For the new box on the W-2, should the wages be equal to the overtime portion of the hourly rate? So there's the new box on the W-2 should only disclose, my understanding is, the premium portion. So back to my example where you had an employee earning $20 an hour, overtime they make $30 an hour. My expectation is you're reporting the $10 an hour premium in that box so that the employee's set up for success in calculating their deduction. And again, there's a grace period on that. So doesn't have to be perfect for 2025.
The senior deduction's available in 2025.
Oh, great. So effective immediately. Thanks, Matt.
Are there any other questions?
I'm not seeing any more come in, so I just want to say thank you both, Matt and Madison, for being here today. As they said, we'll get the slideshow, the slide deck out to everyone, and we will upload the recording to YouTube for later viewing. And we had a number of folks that emailed on the side and said that they weren't able to attend, so they're looking forward to the recording. If you want to hear from Madison again, we're featuring Madison as part of our Chamber Speaker Series next month in a Future is Female-led, celebrating women in leadership. And so you can go to bellingham.com for that. We've got a few other events coming up before the end of the year, including another speaker series, State of Education. Our top 7 under 40, where we celebrate young professionals, is coming up in 2 weeks, I think. And of course, all culminates at the end of the year for us at our annual awards dinner. And so look forward to seeing any of you that want to participate in those events there as well. So
Thank you, Guy.
Thank you.
Yeah. Thank you.